Our greatest teachers are our mistakes, or never be afraid to make a mistake. These are wise words that we often hear in life, but that doesn't mean we have to experience every mistake that everyone else has. We can learn from other people's mistakes. So let's talk about mistakes you should avoid so that investing will grow your nest egg over time instead of becoming your worst nightmare. You'll develop into a wiser investor who makes sound choices and improves returns if you stay away from these 8 investing blunders. Mistake number 1, investing without a plan. One of the most common mistakes investors make is not having a clear investment plan. If you don't have a clear plan behind your decision to invest that spare cash in your bank account, you'll most likely stray off course in times of uncertainty. As you may already know, investing is like riding a roller coaster. Without a well-defined strategy, you may try to jump off when the ride gets bumpy. Studies have shown that people who have clearly written investment plans outperform their peers, not just by a few points, but by multiples in percentage. A clearly defined investment plan has to be smart. Anything less is gambling. Following a smart plan will allow you to look critically at rumors, stories, hot tips, or future predictions of how the market will move. Securing your financial future is your top priority. So you want to create a plan that aligns with your time horizon, risk tolerance, and investment objectives. Having these spelled out stops impulsive investment decisions based on short-term market fluctuations. For instance, you're less likely to buy a high-risk stock with the expectation of making a quick buck if you stop to ask yourself, do I believe in this stock 20 years from now? Remember, you want to invest for the long term, so make decisions based on that. Mistake number 2, not diversifying your portfolio. Putting all your money into a single asset class can be extremely dangerous, but it's one of the most common mistakes that younger investors make. For example, 2010 to 2021 had been a spectacular decade for technology stocks, and many young investors' portfolios showed that. But the last couple of years have seen double-digit declines. If these younger investors didn't balance out their portfolio with other asset types, they've seen huge losses. If you don't diversify your portfolio, you expose yourself to increased volatility, which invites unnecessary risks. If one investment underperforms, like technology stocks, your entire portfolio could suffer significantly. Diversification doesn't just mean owning more stocks. You must consider your asset allocation as well. Adding U.S. equity mutual funds to a diversified portfolio of U.S. stocks, for example, isn't exactly diversification. To properly diversify your portfolio, maybe you consider adding bonds, real estate, or even international securities. The goal of diversification should be to include different, occasionally competing sources of income with the intention of reducing portfolio risk. If one investment underperforms, a well-diversified portfolio can help lessen the impact and potentially compensate for losses with other investments that outperform. Mistake number 3, trying to time the market. It has been repeatedly demonstrated that, regardless of who you are, it is very difficult to consistently outsmart the millions of intelligent, savvy individuals who trade in the market. To successfully time the market, one must consistently make precise predictions of when to buy and when to sell. That means you'd have to be right twice, once to get out of the market before it goes down, and again to get back in before it goes up. As you can imagine, this is extremely challenging, if not impossible. It can be harmful to your portfolio to try to predict short-term market movements and base your investment choices on them. If you do, more likely than not, you'll find yourself missing out on potential gains or suffering losses by buying at the top and selling at the bottom. Either way, you'll be on the negative side of things. One thing you can do, though, is turn off the TVs and stop watching the daily market news so you don't get caught up trying to catch the latest trends. You're most likely too late. Instead, take a long-term investment approach and stick to a plan. Mistake number 4, letting emotions drive decisions. As much as you can, you want to base your investment decisions on rational analysis instead of cognitive biases or fears. Unfortunately, this is what drives investment decisions for some people. The problem with letting emotions take the driver's seat on your journey is that emotions like overconfidence, greed, or fear impair your thinking and lead you to make rash or irrational decisions. Decision-making when it comes to investments may also be influenced by cognitive biases like confirmation bias, the tendency to seek out information that supports our beliefs, and trend chasing, the tendency to follow the crowd. Either of these 2 emotional states can make an investor panic and sell all their investments during a market downturn or be overly optimistic and invest heavily in high-risk assets without proper analysis during a market rally. These impulsive and irrational decisions generally lead to poor performance over time. Have a plan and be disciplined enough to stick with it, even during market fluctuations. Mistake number 5, failing to do research. Not conducting the proper research before taking a chance on investments with your hard-earned money is irresponsible. Yet so many individuals fall into this trap every day. Researching allows you to consider the risk level of the investment, how diversified the investment is, and if this investment makes sense for your long-term strategies and plans. To make the most of any investment, you need to understand these options, otherwise you may incur financial losses from your lack of knowledge. Doing your due diligence will ensure you don't overlook any red flags, like poor management, high fees, or legal issues. We're not saying you have to become the next Warren Buffett of the market, but you should understand the risks and options involved with whatever you're investing into. Keep in mind that in the world of investing, knowledge is power. Without proper research, you're essentially gambling with your money rather than making informed investment decisions. Mistake number 6, forgetting about fees. It can be a very costly oversight not to consider, underestimate, or ignore fees when you're deciding on your investment choices. Since fees like management fees, transaction costs, and maintenance fees can reduce your overall investment returns, you want to carefully review and understand them. If the fees are high enough to significantly impact your investment return over the long term, consider lower cost investment options to make the most of your return. This is important because if you choose an actively managed mutual fund with higher management fees, you assume that the higher fees will result in higher returns. If the fund's performance does not outperform its benchmark index after fees, you'll end up with lower net returns compared to a simple low-cost index fund. So regularly look at the fees associated with your investments to ensure they align with your investment objectives and prioritize the options that maximize your returns over time. Mistake number 7, ignoring the impact of taxes. Take a look at these numbers. Assuming as an investor, you bought 2,000 shares of a stock for $20 each and sold them for $50 each after 2 years, you realize the capital gain of $30 per share. If you ignore taxes, you might believe that you just made $30 per share. In reality, you only made $25.80 per share in net profit if your capital gains tax rate was 14%. From the numbers you've seen, if an investor ignores taxes, it always results in a lower net return, which could potentially hinder an investor from achieving the financial goals he set for himself. So considering tax implications and incorporating relevant planning into your overall strategy is always a good idea. Mistake number 8, investing money you can't afford to lose. This is the basis of financial stress, vulnerability, and potential debt. First, investments are always risky, and there is always the possibility of losing money. If you invest money you can't afford to lose, you put yourself in a financially precarious position, leaving you vulnerable in an emergency, and, on occasion, forces you to liquidate your investments prematurely, which may result in a loss or make you miss out on potential gains because you exited too soon. For many investors, the prospect of losing money causes emotional distress, which can be harmful to both mental and physical health. This impairs the ability to make sound investment decisions, resulting in actual losses. Be careful with the money you put into the market. Discipline, research, and a long-term outlook are required to avoid these harmful investing mistakes. It's important to have a clearly defined investment plan, diversify your assets, trade less on emotions, and adopt a methodical and educated approach to investing if you want to increase your chances of reaching your financial objectives and creating a profitable investment portfolio. Keep in mind that investing requires patience because it's a marathon, not a sprint. Thanks for watching. If you like this video, share it with a friend. Please like, subscribe, and hit that bell icon so you don't miss out on new videos. See you in the next one.